Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Can the new shovel sellers replicate NVIDIA's miracle? 20260522. This video presents a direct informational narration of the source document. All right, let's jump right into the market's close for Friday, May 22nd. U.S. stock indices ended the session mostly flat today, so we're basically seeing a pretty quiet transition heading into what will be an extended holiday weekend.
Let's take a quick look at the upcoming market schedule so you know exactly how this holiday weekend is shaping up. While equities closed flat today, the bond market actually wrapped up early at 2 p.m. Now, this coming Monday, May 25th, the market is going to be completely closed in observance of Memorial Day. Regular trading operations will kick right back off on Tuesday. It's actually absolutely crucial to keep this specific timeline in mind, you know? Extended weekends almost always result in lower liquidity right before the break, and any new developments that pop up over those 3 days are going to be priced in immediately right at Tuesday's open.
Now, shifting gears to the geopolitical landscape, we need to examine some fast-moving developments. According to sources cited by Reuters, a Qatari delegation just arrived in Tehran, and this was a move actively coordinated by the United States. Concurrently, the Wall Street Journal is reporting that mediators are literally racing against the clock to broker an agreement. The primary objective here? Averting impending strikes by the U.S. and Israel. As the source text points out, these types of geopolitical updates often inject immediate volatility into the markets, so it requires our very close monitoring.
And this perfectly highlights a major structural shift we're seeing in monetary policy communication. Today, Kevin Warsh was officially sworn in as the 17th chairman of the Federal Reserve, and during the ceremony, President Trump announced that the Fed is going to fundamentally change its approach. The previous policy, as you probably know, leaned heavily on forward guidance, signaling rate decisions well in advance to kind of prepare the market. But the new policy, forward guidance will be severely limited. Moving forward, decisions on rate cuts or hikes will be announced directly at the meetings with zero prior public signaling. While the mid to long-term impact of this is largely viewed as neutral, losing that early signaling is widely expected to increase short-term market uncertainty and, for sure, exacerbate equity volatility.
So, sticking with interest rates for a second, we have to talk about Governor Waller. He completely pivoted away from his previous dovish stance today, delivering a noticeably hawkish message driven by incoming data. He stated that recent labor and inflation data have fundamentally altered the baseline view on interest rates. Because of that, he noted that the very next move could equally be a rate cut or a rate hike. He even suggested that rising Treasury yields might actually do some of the heavy lifting to suppress U.S. inflation. This rapid shift in tone briefly caused Treasury yields to erase their intraday losses before falling back down, which in turn triggered a quick intraday dip for U.S. equities before they managed to recover.
These macro shifts tie directly into our broader market performance metrics. The S&P 500 index actually tested that major 7,500 resistance level today, but it ultimately closed just below it amid lower pre-holiday volume. But despite hitting that resistance, the index has officially secured its 8th consecutive week of gains. That's its longest weekly winning streak since way back in December 2023. A massive engine behind this momentum is corporate earnings. With over 90% of components having reported, Q1 year-over-year earnings growth is projected at a staggering rate of over 28%. This exceptional corporate profitability and the high expectations for future economic growth that come with it has really been the primary pillar holding up this current market rally.
However, as that initial boost from peak earnings season starts to fade, we really need to keep a close eye on the macro indicators. Get this. The Bank of America Bull and Bear indicator just hit 8.0. Hitting this exact threshold triggers a historical contrarian sell signal, and this marks only the 17th time we've seen this happen since 2002. Historically speaking, when this specific signal gets triggered, it has preceded a global equity pullback averaging around 2 to 3% over the following 2 to 3 months. Now, while this is a matter of statistical probability and definitely not a crystal ball guarantee, it's an absolutely crucial data point for institutional strategy as we move forward.
Turning our attention over to individual equities, we've got a major structural update regarding Estée Lauder. The company officially terminated its merger talks with the Spanish beauty group Puig. The original goal of this merger was to forge a massive, high-end beauty conglomerate to really take on the industry leaders. But Wall Street institutions were voicing some pretty significant concerns. They were worried about severe integration risks, added pressure on Estée Lauder's balance sheet, and the very real potential to distract management from their core turnaround plans. Because of those heavy institutional concerns, dropping the deal was actually viewed as a major positive, and that directly led to a surge in Estée Lauder's share price today. Now, what's genuinely fascinating here is the phenomenal performance we're seeing across both the retail and hardware sectors. First off, hardware saw broad gains. Lenovo beat revenue expectations, and Dell just surged over 16.8% to hit a brand new all-time high after an analyst aggressively bumped its price target to $270. But take a look at raw stores. They delivered incredibly strong Q1 earnings. Sales jumped 21% to $6 billion, and EPS shot up 37% to $2.02. Because of this, they've significantly raised their full-year guidance. Comparable sales growth is now projected to hit between 6 and 7%, which is a huge step up from the previous 3 to 4%. Full-year EPS guidance has also been bumped up to between $7.50 and $7.74. This exceptional performance marks a blistering 11-month winning streak for the stock, vastly outperforming broader retail peers like Walmart.
Next, we're transitioning into the cutting-edge realm of quantum computing. IBM just locked down a $1 billion government subsidy, which they are matching dollar for dollar with $1 billion of their own capital, to build the first 300mm quantum chip foundry in New York. This is huge. It signals a massive strategic shift from long-term R&D right into a core, national-level manufacturing platform. Looking at the Wall Street price targets, the end of 2026 average sits at $321, with a high of $334. But look at the 2030 projections. There is a very significant divergence based on execution. If traditional businesses shrink and execution fails, the bear case low could plummet to $130. However, if their quantum foundry model successfully scales commercially, the 2030 bull case high reaches an impressive $484.
And this brings us directly to the core concept of the new shovel sellers in the quantum race. GlobalFoundries has just secured a $375 million U.S. government award. Their critical task? Developing cryogenic control electronics. You see, quantum chips literally have to operate at near absolute zero, and standard chips just fail completely under those extreme conditions. Because GlobalFoundries has been pioneering this low-temperature technology, they are now actively partnering with giants like Google, Microsoft, and NVIDIA. Essentially, they are building the foundational manufacturing infrastructure for the entire quantum sector. While quantum is clearly still in its early stages, platform companies providing this base layer could become massive long-term beneficiaries. Oh, and briefly pivoting to the space sector today, Oak Labs secured a $90 million Space Force contract for geostationary orbit satellite production.
Finally, we have some major regulatory developments out of China concerning cross-border brokerages. The CSRC has issued a strict prohibition against offshore financial institutions providing cross-border services to mainland residents. Existing mainland accounts are going to face a 2-year buffer period where they can only sell, not buy, before being entirely cleared out, and the financial penalties for past violations are severe. Tiger Brokers faces a 308 million RMB fine with 103 million RMB confiscated, noting that 10% of their user funds have mainland exposure. Futu was hit even harder, with a massive 1.85 billion RMB combined penalty, and its CEO received a 1.25 million RMB personal fine, with their mainland exposure sitting at 13%. Both of these companies have been actively developing overseas markets to prepare for exactly this policy risk. So, analyzing all of this data, what are your thoughts? Could these foundational quantum infrastructure companies really become the next NVIDIA-level opportunity? And how do you think these global regulatory shifts will alter market dynamics? We invite you to share your insights below.